Well, good evening or good morning wherever you are around the globe. It's a quarterly review up until the end of 2021, the end of the December quarter, but I've also included obviously a lot of data that's happened or that we've received between then and now. In fact, some of it just out today. So I'm going to go through a lot of the things that we're looking at. What can we expect in 2022, and not just in terms of the housing markets around Australia, but also in terms of finance. Clearly the thing on everyone's mind also these days is inflation. How are central banks going to react to these very sharp increases in inflation? So we've got Q&A at the end, all those things, but I'll go into it. And just for the people who don't know us, there's a disclaimer. This is general advice. It's not specific or specified financial advice for anyone, so it's general information, and if you need advice, obviously you can reach out and we can probably assist you with that. But in terms of who we are, I founded the Unicorp Group over 30 years ago now, and we started out providing financial advice mainly for my peers, so young medicos, young doctors, and that moved into the other professions and then into the area of commerce. A lot of people in the banking and finance sector who moved around the world, as we know people do, especially in those roles. And so we developed an expat client base by default over many years, and later on we now have encapsulated that as part of one of our specialties. So we've been doing this for over 3 decades, trying to help people build their assets, reduce their taxes in a structural manner, and they're looking to build their wealth in a tax efficient manner. And most people, we find, want to include real estate property as part of that portfolio. So it sort of brings everything together. We have a number of different enterprises there to assist people with that. We've got the advisory business, which is Unicorp Partners based in Australia. We have the international consulting business, which is Wise Guru. We have the lending business, Aussie Loan Guru, and the Australian real estate business, Aussie Property Guru. And that sort of gives you a bit of a background in terms of, some of the capacity that we have to assist you depending on what your particular wants are. So what are some of the things that people have been asking us currently? What are the most common things? And clearly this is not an exhaustive list, but most commonly people have been asking us, well, now it's, not when will central banks raise, when will be the RBA raise, but how much will rates go up by, how long will that last? And of course, these things are going to be influenced very largely by not just inflation, which we've already seen coming through at spikes both in nominal and core values, but it's going to be driven, certainly from an Australian viewpoint, largely by wages growth in terms of how the RBA reacts to these inflationary pressures. And Phil Lowe's come out many times and said, look, we want the core inflation to remain consistently within that target band of 2 to 3%. In fact, he said we're kind of happy if it goes above that for some period of time to ensure that wages growth comes in, above 3%. Works through, I suppose, how to best engineer this soft landing for, certainly for property markets and for the economy in general. So how is that going to impact property prices? If we've got this rising interest rate environment we're now already in, we'll look through that in some detail as we go through. The other thing that's important, population growth, the lack of international migration. Australia now opening its border next week to tourists and obviously allowing migrants to enter the country again. Is this going to be the kickstart of something? Which markets are going to be impacted? And that's very important, because I think this year it's more important than ever to look at how the different markets are going to react to some of these changes, some of the tailwinds and some of the headwinds we'll be experiencing throughout the year. And lastly, but certainly very importantly, how do we navigate this current interest rate environment? Because there are many changes that are happening at the moment, and I'll go into more detail as we go through the information I'm going to share with you. We all know Australia is a very large country, and one of the interesting things at the moment, of course, is that Western Australia is almost not a part of Australia in relation to how the West Australian state government has been dealing with the pandemic and restrictions in relation to that. So research is really essential because it can have can help you with great insight into why things are occurring in some states rather than others. So we use, the national research houses, CoreLogic. We obviously use the ABS, any of the government agencies that supply us with data, Resolution Research, Oxford Economics, Urbis, and so on. So, let's have a look and see what some of these things give us and what they show us. So for now, the question is how much and how far in terms of interest rates. This goes through to the last meeting at the beginning of Feb, and as we all know, the RBA held the cash rate at 0.1%, as it expects to for some months to come, and obviously various economists are divided about when the first rate hike will come, and I'll show you what I think. So the other thing is obviously the QE has stopped, so no more bond purchases from the RBA, and currently the bonds that are there on the balance sheet are about 356 billion. Some of these forecasts that the RBA has made in terms of GDP growth and inflation are being challenged by some economists, but look, I think they're probably pretty close to the mark on many things, and they keep coming back and saying we're not here to address what's happening with the price of housing. We're here to provide financial stability and look after the financial system. So let's look at all of that in some context. And if you look at rates, as we told our clients last year, my belief was that fixed rates will move up, and they have. And they're continuing to do so, actually, even as we speak now. They've moved up consistently in the last 6 weeks. So continuing to increase for most of our viewers. We're looking at investment rates which are higher than for homeowners, for owner occupiers, and I can see that continuing. So at this point in time, if we look at it in context of history, we're still at really ultra cheap interest rates. So if anyone is sitting around that's been around for a while, if somebody said, look, here's your investment loan and the interest rate's got a 3 in front of it, well, you would have been very surprised. So I think people need to bear that in mind, and if they are at all concerned about the interest rate burden that they may have to bear, fixing rates for some period of years currently can still be done at what I think is historically a very attractive interest rate. So you can see there, you can see that on screen. 3-year bond yields have moved up pretty, spiked, I guess, as we thought they might, and that'll continue. So there's going to be ongoing pressure on fixed rates to rise because banks obviously obtain those funds not as from deposits against the variable rate, so it costs them more. Cost of funding is higher, and I'll pass some of that on. So here's Westpac's view, Bill Evans, in terms of where they see things like the cash rate heading, the 10-year bond yields, and the Aussie dollar. So they've penciled in, they think the first rate rise will come in August this year, and it'll be 15 basis points. I think we might get a couple of rate rises later this year, to be honest, and we might see the cash rate at 75 basis points by the end of December. We'll have to wait and see. Westpac's view is not that. They're saying 50 basis points, 75 in March, and so on. There's a 10-year bond yields. And also in relation to the Aussie dollar, as you can see there, staying pretty much below where its current level is for most of the year, and then moving up slightly towards December. I don't necessarily agree with that view. I think with commodity prices doing what they are, with China perhaps coming in as they're showing and looking to stimulate their economy through potentially moving in the opposite direction to the rest of the world and making monetary policy more accommodative. I think all of those things are a potential tailwind for the Aussie dollar. If you look at it again on a historical basis, it's quite undervalued at the moment in relation to where commodity prices are. So I think, I actually think that this number is probably a bit low. In my estimation, I think the Aussie dollar could certainly trade in the mid-70s during this year. And as we all know, trying to pick FX is very difficult, so time will tell. Now, this is the important one, I suppose. We've seen interest payments come down massively during the pandemic. They came down to a level of 5.2% if you look there at the sort of bottom of that graph as a percentage of income, of household income. But before COVID, they were sort of running at around consistently about 9%, and the market's pricing in a slightly higher rate, over 2%, by the end of 23 actually. So if that happens, that may go slightly above the 9% level. That's ANZ's forecast, and that they have it below. So if you look at all of that, interest coverage as a percentage of household income is not likely to blow out. And the other thing we've got to think about is, of course, that if you have increasing interest rates, cash rates from central banks, that's generally because the economy is running hot, so going well, and there'll be obviously wages growth to go along with that. So that's going to impact this ratio also, and I've just made a note of that. The thing here that many people forget is because, like we advised our clients, many other people did too, and they took out fixed rate loans, and that was generally over the last sort of 15 months. So most people took out fixed rate loans, certainly a lot of ours did, that were 5-year terms or 4-year terms or 3-year terms, and it's going to take a while for those to roll off. So, this whole change in interest rates is going to have, I think, a bit more of a muted impact, because about 30% of outstanding debt currently is on these fixed rates. So, I think that'll give people some time to accommodate things. But what I think about is, and that's my last point down here, we do need to watch the impact of some of these loans which have been interest-only loans rolling off and then potentially going into a principal and interest repayment scenario. So that's where I guess repayment amounts in aggregate will increase, even though clearly people are paying down some of their capital debt. If we have a look at this, it's quite interesting, because if you look here, all of the vacancy rates really have been coming down in all of the states, but clearly from different levels. So that's going to have an impact on many things, and certainly on the rental yield's an important factor when investors in property are looking at some of their outcomes if they're borrowing money, so their gearing outcomes. The other thing that we get asked and is very relevant is how much population growth is going to occur, because as we all know, Australia's locked its international borders since the beginning of somewhat into the pandemic, and is now reopening them next week. So clearly it's not like just opening a floodgate where people rush in. Bureaucracy moves pretty slowly. So, whilst tourists can come in, certainly I see, international students coming in, but some of the skilled migrant workers and unskilled migrant workers as well, it'll take some time. So, I think we need to, and I've just put that there as a thought box, I'll come to it later on, but interstate migration will potentially have a larger impact, I think, during the course of 2022 on some of our major markets rather than international migration. It is worth noting that the government is looking to kickstart things. So, they said they're going to try and bring in an extra 200,000 skilled and unskilled migrants from overseas to assist Australia, assist the economy with some of the supply bottlenecks that have been caused by a lack of labour. So that's a good thing to have happen. But, I'll sort of look at these projections, and this is from the Commonwealth Government. If we look at what's going on there, population growth from not natural births, as we can see there, they're the green bars. It's going to increase, but I think it won't kick in really until 23, 24 and get back to those normalised levels from there on in. So I think we're going to have to just look at that. This year I don't think is going to see that massive kicker coming through, but it will come, and there's some very important outcomes obviously that may deliver to some areas. So the other thing that people are asking us about, what's the RBA doing, what's APRA doing, what are the regulators doing in terms of credit growth, because sometimes this gets reported as being, perhaps larger than people think, because if you have a look at what's happened in reality, much of the credit growth and the spikes in that we've seen, certainly over the last 18 months, have been to owner-occupiers. So people buying new homes, upgrading, downgrading, right-sizing, whatever the case may be. And as we can see, investors have made up a far smaller number there, and it's about, less than a third of the total number. So very important to see how that actually then transposes in real life, because a lot of these home buyers, a lot of them fix their rates at around 2% for up to 4 years. So again, I think this will probably play out reasonably well in relation to making any changes to the variable rate, not as perhaps as severe as if everyone were on a variable mortgage rate. So pretty good outcome, I think, for everyone. But it's something worth watching, and it's not, I don't see that as being an overinflated situation at this point in time. So if we have a look at investor finance nationally, it's actually come down a little bit since the October data. It's kicked back, as we can see, in just about every state, and then just had a bit of a blip there. So that's turning up again now as I look at data from January. So again, these things will adjust along the way, but I think it's more rational to look at this and say, well, it's not that the investors are piling in and driving this increase in finance. It's mainly it's the homeowner market. So because people worry clearly that APRA might step in, as they did in 2017, with some further macroprudential measures. I mean, what they did initiate late last year was they increased the serviceability buffer rate from 2.5% to 3%. So banks have to add that on. And that, again, I think is a lot of stability in relation to people's serviceability capabilities, I suppose, on their loans, because they're already being assessed as if interest rates had gone up 3%. That hasn't flown through to this data set yet, because it only actually was enacted on the 1st of November. But on our next quarterly review, we'll see what's happening there. One of the measures that they're looking at is this debt to income ratio of 6 or higher, and banks will vary that a little bit. That's moved up. I don't think at this point, alarmingly. I think what we look at also is the percentage of interest-only loans, which has remained, at a fairly benign level. So currently, I don't think the regulators are too concerned, as we can see their high LVR loans. Again, dropping off, if anything. So all of those issues, or lack of issues, it's pretty helpful for the RBA and for regulators. All right, so if we look at property, residential property as an asset class, and we have a look at what's happening, clearly the rate of growth has started to slow, thankfully. because we speak to a lot of people who are first home buyers or keen to enter the market, perhaps even as an investor. So the rate of growth has to slow to be sustainable, and that's started to happen. So, but we've got to put all this together, because you can look at all of these statistics all day long, and unless you actually can put that together in a meaningful way, you just keep looking at statistics and you don't know what to do with those numbers to give you a bit of an advantage, I suppose, over peers. Something that people in Oz forget about is that housing price growth in Australia is sort of middle of the pack if you have a look there, and it's lagging many countries. One of the ones that I look at, for obvious reasons, is New Zealand, because their housing markets, and they don't have as many as Australia clearly, have moved ahead, well ahead of ours, and we look at the data from New Zealand as a little bit of a sounding board perhaps as to what we might expect in Australia. So it's a handy indicator for us, and what the Reserve Bank's doing there, it's obviously ahead of where the RBA is and what impacts that's having. So if anyone's interested in that data, I can share that with them. This came out just the other day, and it's the NAB with their current views on what prices of property will do both this year. So up here, 22 forecast. So they see fairly anemic growth, I guess, in most capital cities, highest in Brisbane and Adelaide, and then they see 2023 as being negative, as we can see there. 11.5% in Sydney and Melbourne, and less so as we go through again Brisbane, Adelaide, Hobart. But and I put this up here. This is something that Westpac put up, and Bill Evans put this data together. It's something that I've spoken to him about in the past, and I've seen plenty of experts come out, or economists come out, and say that we're going to have a housing crash. But if we look at it historically, there've only been 4 periods between 1981 and 2021 where prices have actually declined by over 5% in a year on a national basis. So, one of those was the GFC. Another one, obviously, probably the greatest one, was the technically engineered one between 2017 and 2019. So I think that's worth bearing in mind. And if you have a look at Westpac's forecast, which they just updated again very recently, so last week or two, they're seeing 2022, this current year, zero growth for Sydney and Melbourne, Brisbane at 8%, Adelaide at 8%, as you can see, and then negative numbers in 23 and 24 for most instances. It's something that I guess, time will tell, as we know, but I sort of have a look at it in this light. And this came out just today. So ANZ revised their forecast today, and they now anticipate, as you can see there, some relatively solid gains, especially for Brisbane and Hobart. So, for Brisbane and Adelaide. And it's something we've been saying for a little while. I think it probably will continue this year, to be honest. I'll come through to that later as to why that may continue. But certainly their forecasts have now varied from those of the other banks. And I tend to actually be more in this camp for this year. Next year, it'll depend a lot on what's happened to rate rises, what's happened to bond rates and so forth. So a little bit harder for me to look out that far and see what's going to happen, but we can follow that data during the year. So if you have a look at this in terms of the rolling quarterly changes, as we can see there in the major capitals, so you've seen Sydney and Melbourne are trending down quite nicely there in relation to rate of change. Brisbane and Adelaide are still enjoying that upward trajectory. And here, if you have a look at the rolling values, Darwin and Perth have really come off quite strongly. That may be in relation to WA, certainly the borders being closed and the way they're dealing with the pandemic. But it's important to note these things, and especially if you're looking to perhaps enter the market or add to your portfolio as an investor. Sometimes being more diversified in the higher quality end of things might be very helpful. So interestingly here, where we've had in the past, if I've looked at the last couple of quarterly reviews that we've done, you had the top quintile, the top 25% value growing the fastest. That's sort of reversing, and you're now looking potentially at some of the lower price point properties showing greater growth. So maybe a bit of affordability coming through there and acting as a bit of a dampener on some of the highest priced properties in these markets. And that's something that I think may continue certainly over this quarter and perhaps the next one. The other thing that we always look at is supply and demand, as with anything in any market. And as we can see there, if you look at these numbers in November, you saw a really sharp decline in unit approvals. That's bounced back to close to their decade averages. Freestanding homes have come down. A lot of that's been caused, I think, by when we had all of that stimulus, the home builder, other grants coming through last year and the year before, that pushed a lot of demand forward, and that's now rolling off. So that all makes sense, but keeping an eye on that supply and demand, I think, is important. Obviously, on medium density housing or higher density housing, those approval times and build times are much longer than on freestanding homes. So some of those trends can linger. Okay, so if you look at the other thing that people ask about, and rightly so, is the what's happening to my rent? Well, rental yields have continued to decline. They're down 3.2%, and a lot of the reason for that is because it's an inverse to capital values. So capital values, as we can see, have been rising quite strongly, and even though the nominal rental values have gone up some 9% really on a national basis, the yields have still trended down. And if you have a look at this, at the bottom of the pack is Sydney. I think most of us would be quite aware of that. But if you look at it like this, and I put this up so that people can perhaps get a bit more context out of this. Look at houses. The median rent, Sydney, the highest one's 2,300, and the lowest one's 404 per week. So a massive discrepancy between the top and the bottom of that. And if you have a look at this, top 30 most expensive suburbs to rent in Sydney, I've cut that down to 10. But if you have a look at this, 1.5% is a pretty low yield. So if you're getting $150,000 a year rent, that means that property is probably worth around $10 million, and you can extrapolate it up and down from that. But it's something that people need to be, I guess, cognizant of. So when we talk about, or when you see in the news, rental values, rental yields, you have to look, there's a whole lot more to it than that. You've got to be far more granular in terms of making decisions based on some of these sort of generic statistics. And that brings me to that. So, what does the data tell us, and how do we use all of this research? Well, let's have a look at, real estate. It's now heading close to $10 trillion in terms of value in Australia. And more importantly, I suppose, what I look at too is that, outstanding mortgage debt against that is about $2 trillion. So we're not highly leveraged, and I think that's important. Whilst the level of debt obviously is far greater than it has been, and the cost of servicing that is clearly far lower than it has been, overall it's not highly leveraged. So that's something that's important to look at. If you look at commercial real estate, that hasn't moved nearly as much, and I think obviously one of the main reasons for that has been what the pandemic has dished out in terms of particularly office commercial properties, retail and so forth. They've been very challenged. So if we look at Australia, there is no Aussie property market. it's different in every state capital, in all the regional centres, and that's what we've got to look at. What else can we consider to give us a hand when making decisions here? So, we've been stipulating this to our clients for a long time. It's as easy as pie. Population growth, infrastructure growth, and employment growth. Three key fundamentals that I think you'd like to have if you're going to purchase a property as an investment, because they should underwrite to a large extent what's going to happen to that property over the long term in terms of growth and income. So this slide, I just wanted to bring that up because quite often people misunderstand investment for speculation, and property is certainly not an area you want to do this in. You could be lucky and you could buy something and speculatively sell it in a short space of time and make a nice nominal gain, but generally speaking it's more for the long term, and funnily enough, the longer you keep something the luckier you get. But if you have a look at this, as of September last year, the median hold period for resales across Australia was 8.8 years. So that the median initial purchase price date was around December 2012, and over that period national dwelling values increased 62.4%. Now, the highest level of sales though happened in years 4 to 8 here, but interestingly enough, or maybe not interesting enough, the highest nominal returns were in years 20 to 30 plus, if you have a look at that. So, if you bought a decent asset, a quality asset to start with, and kept it, you can see from an investment viewpoint how that compounds out. If you look at it there in terms of how long people tend to hold things, again, these are sort of aggregate values, it's far less than that. And then obviously you've got to delve into what are the tax outcomes in relation to that disposal and so forth and so on. But it's something that's worth really looking at and thinking to yourself, well, unless I've got a better use for my money, why am I disposing of this asset? The sale costs can be high, transaction costs, etc. So it's something that you really need to think about. So if we look at the various markets, so let's look at some of the capital city markets. I mean, Sydney is a premier market in Australia. New South Wales still got the most diversified economy. There's very strong demand, especially for quality dwellings. But recently I've shown you the market, the rate of growth has come off, and thankfully for that, because it was, earlier last year was growing at a sort of 4% per month rate, and clearly 48% per year on an annualised basis is not sustainable. I think there are some downside risks there now due to affordability, because that may be getting a little stretched. So it's something you need to keep an eye on. And if you have a look at what's happened in that market, if you look at the quarterly changes, 2.7% over the quarter, certainly still a healthy rise, and 25%, over 25% in the last year, but just 0.3% in December. Some of that could be cyclical due to that time of year, and I look at the current numbers and that's bouncing up actually fairly strongly. So Melbourne, similarly, it's a bit different. The Melbourne market's different. Obviously, it was locked up for 270 odd days during the pandemic. So that's had, I think, a fairly profound effect on the market. But the other one that I think is harder to jump out of, and that is this lack of international students, because Melbourne was probably the greatest recipient, next to Sydney, of international students, and that's really impacted the market, especially in terms of the rental market closer to the CBD, but that's spread out from there. So this loss of overseas students hopefully will now start getting rectified. As I said, I just want to keep an eye on how quickly that occurs. So that population growth issues for now, but I think that'll start rectifying itself. Last quarter, as we can see there, was pretty weak, 1.5% compared to the other capital city markets or East Coast markets. And December, there was actually a slight negative. So still up 15% over the last year. And, I think Melbourne should perhaps do better as you know some of these overseas migration matters start getting sorted out during the year. WA has been an unusual one. I mean, their commodities have maintained, stable employment conditions. This lack of diversification of the state economy has been a tailwind, a positive. Still very low vacancy rates, as we saw earlier, but the rate of price increase has diminished far more than other areas. So you can see that graph pointing down there more than some of the other cities, and you look at it, quarterly increase of 0.4%, 13% over the year. So Perth is still 2% below its prior high water mark reached in 2014. So Perth and Darwin are the two capitals that are still below their prior peaks, and we'll keep an eye on that. But I think it'll still be challenged for some time during this year. So if we move on to this, people often ask me, should I buy an old property or a new property? And as I say, that really depends. It depends on, I guess, how much time you have, what your skill sets are. So for most of our clients, as I said, they're very time poor and they want a no-touch if possible, but otherwise a light-touch situation of owning investment properties. So they tend to go for new properties which are easier in terms of management by an agent, no repairs, structural or otherwise, and usually you can get higher yields, so tenants will pay more for properties that are obviously built to modern standards in many ways, energy efficiency, etc. But if you perhaps were in the construction industry and you're looking towards retirement, then you could add value through renovation or through redeveloping an old property. So it just depends, I think, on people's personal situations. There are in Australia major tax benefits from buying new properties. Division 43, you can deduct 2.5% of the building cost for 40 years, and that's not a cash outflow, same as Division 40 in fixtures and fittings. So you can get some pretty decent tax deductions that you're not paid money out on an ongoing basis, and that will influence the outcome, obviously, of the overall investment over time favourably for you. So they're all things to bear in mind. Now let's have a look at where we think might be a good area in this current period of rising interest rates in the economic cycle, and what the data is sort of supporting our view that we've had for some time, as some of our viewers will obviously know. And the easiest pie points to Brisbane and southeast Queensland. So here we do have this population growth continuing with the strongest interstate migration in the last 15 years, quarter on quarter, as I'll show you. The economy is a diversified economy. This substantial valuation gap that exists, that has become more substantial because, as we've seen over the last couple of years, Sydney's gone up, and what was perhaps a $2 million property in Sydney could have been a $1 million one in Brisbane. I mean, that's just really gone further, and so now a $3 million property in Sydney could be 1.5 in Brisbane. So in terms of nominal amounts and dollar value, that's actually increased that valuation gap. And the other thing, which may even be somewhat structural, is this work from home situation where employers are recognising that may be perhaps a more lasting feature. Employees are also saying that they like this as an outcome. So we've got to look at how that plays out over the next few years. But I think, again, the lifestyle factor has contributed to people wanting to move to some of these locations located in southeast Queensland. We've seen pretty strong growth here, as we can see in that graph. Last quarter 8.5%, 27% for the year. So we actually see growth continuing more strongly in this region than any other in Australia this year. And if you have a look at these interstate components, I mean, you see this massive outflow of people from Victoria, nearly 45,000, and nearly 46,000 people going into Queensland. So we see that continuing. It was there before COVID, and it's really, received a tailwind from that. So I think that's an important thing. And some of the regional areas there, the Gold Coast and the Sunshine Coast, obviously have been very strong beneficiaries of this work from home lifestyle move that people have been making and moving to regional areas. So we see that continuing, and potentially people moving from Victoria this year, although that should ameliorate over time. So if we look at these cycles, we think that southeast Queensland is on this growth trajectory which started last year, and will continue due to some of those fundamental drivers that I've just shown you. And here's some new ones, I suppose, that weren't on the cards before last year. The Olympics, now clearly it's not the event in itself, but all of the infrastructure that gets built for that, the economic benefits that are derived in these various locations, and it's not uniform. So we've got to look at this on a more granular basis and say, where's that going to be maximised? But that's going to be a tailwind for Brisbane and southeast Queensland for the next decade plus. So I think it's important to look at all of these underlying events that are playing out, and I'm not going to go through all of this in detail, but I'm happy to share any of this with anyone that would like more information on it, because there's quite a lot involved. The infrastructure side, so the population growth there, the infrastructure side, there's a plethora of infrastructure projects that are currently in progress in southeast Queensland. There are some more on the drawing board, some more that have been started. So again, as in fact in New South Wales and Victoria also, infrastructure projects are really performing what they should be. They're adding efficiencies to the country, they're creating employment, and the government's been assisting, both federal and state governments have been assisting in this. So again, a very important issue to focus on. And on the employment side, clearly infrastructure growth and development creates employment, both initially to build things and then on an ongoing basis. And if we look at transport infrastructure, it enables people to move more rapidly and more easily to certain locations. That's going to provide future housing demand. So we look at this, we look at it in more granularity in terms of which sectors are showing the greatest growth in various states, because that'll give us an idea about what those demographics are looking for in terms of housing, whether that be to buy or to rent. So all these things are really important, and as you can see, there's a lot more to all of this if you want to be a bit more quantitative in relation to using the research for your own benefit and giving you potentially a better outcome. So, if we look at that in terms of some of the value proposition, we like to assist our clients to make sure they don't make some of the common mistakes. One of these, it's human nature, I guess. People always like to buy into something when it's peaking. So we like to make sure that clients buy into something, a strong market of the future. And so even in southeast Queensland, you've got to look at some of these markets and look at perhaps some things may have got ahead of themselves. So it's important to do that. Waiting too long to invest for no reason other than you're not going to do anything is another common mistake that people make. And it's something that really can be overcome just by looking at things quantitatively, because generally people don't do something because they worry. And most of the time they worry about things that are never going to happen, or have already happened, or they have no control over. So there's no lack of information out there. You can go on the internet and get information these days, and research on just about anything. You've got to know what to look for, and then you've got to know what to do with it. Otherwise, you'll just end up getting confused. But, ignoring your point of difference is something that, again, people do, and you shouldn't, because, we look at supply and demand, and it's supply and demand of what? People talk, is it houses or apartments? Well, no, it's a lot, it's a lot further. It goes a lot further than that. So any investment won't do, and try and pick something where you have a point of difference. because clearly the supply of that is generally far, far less. So, this situation, we've had this here for a while, but it still holds true. Where there's an oversupply of investor grade sort of uniform dwellings, usually quite often in very large high-rise towers where you've got hundreds of small 1 or 2 bedroom apartments. Now whether that's in Docklands or in Surfers Paradise or wherever, doesn't matter. That's something that I would stay away from. Single theme economies. Port Hedland was a good one. I lived there as a boy, so for a while I know the place reasonably well. All of these things, don't look at that, and they can be sold to people in terms of how much yield they're getting, how much rent, or a holiday destination. But the reality is they may not be the best investment choice to make. So if we look at supply and demand, and this is for Brisbane, there is a diminishing supply. If you look at that currently and look at where things peaked back in 2016-17, there's been a massive decline, and there hasn't been to date certainly any great rush of developers trying to, if you like, rectify this. So it's something that's going to take some time, and because the lead times are obviously far greater than if you're going to build a freestanding dwelling. So that's something that we're keeping an eye on, and that's also, I suppose, leading to upward pressures on rents where people are looking for quality dwellings in these sought after locations. And we're certainly been seeing over the last 12 months increases in rental values. Now some of those are larger than others, and it all depends on where the property is and what it is and so forth, but the trend is certainly there. And the other trend, it's an important one, is what people are looking for, and the pandemic has probably, I suppose, highlighted this. So people are looking for more space. That's why houses have been very popular. If it's apartments, people want larger apartments, so ones that are built for owner-occupiers, large 3-bedroom ones or large 2-bedroom ones with a multi-purpose room. So these things are really important, because working from home, especially perhaps if you have young children, creates this need for greater space, more versatility in space and how you can utilise that, working from home spaces where you can lock yourself away. So that's been important. And then regional living, as I've said, these work from home lifestyle locations, and we've seen some of our clients that have moved from the large capital cities to regional areas. And I think that may be structural, because I can't see those people then selling those properties they bought as their homes to move back to the city in the immediate future. So I think these are really important things, and where you do your own research, I think that helps you understand how some of these statistics are comprised. So putting it all together, we want that strong economic activity which creates employment growth and population growth, because people are going there to work. It's largely driven by infrastructure projects or infrastructure development. Make sure you do have some unique attributes for your property, and that's sustainable going into the future, and that people will want to live there going forward, because that's what's going to give you good quality tenants, generally a higher yield in terms of rental, and better capital growth over time. So they're all really important things that everyone needs to look at. I've put this slide up because we get a number of requests from our clients around the world, Australian expats, in relation to how can I be an expat first home buyer, and I'm getting some money, but I don't have as much as I want. So look, you can do this in certain circumstances where when you're going to move back, and if you're buying something that you're going to build, whether that be an apartment or a home, you might be able to do that with a 10% initial deposit, but you've got to be an individual, not a company or trust. And this is in relation to New South Wales. So these rules vary state by state, and I'm not going to go through everything in detail here, because it's really to, I guess, put up here and let people know that if they need assistance or advice in relation to this, we're more than happy to help them. and see how they can potentially benefit from some of these benefits that the state government may assist them with. It's probably not going to work for a lot of people, but if it does, then it's certainly a bonus and it's worth exploring further. The things we look for, as I was talking about sustainability and points of difference, modern luxury townhomes in sort of, as we call it, the inner middle ring of any of the capital city markets, oversized boutique apartments, which are sort of right for that right sizer market, which is a segment that's been growing strongly, in that sort of 3 to 13 kilometre radius of most CBDs. You'll tend to do well out of those sort of regions. The coastal markets, this is on the Sunshine Coast, Gold Coast, more so in my mind than say the Central Coast of New South Wales, and that's due to employment and infrastructure and population growth metrics. I think those are pretty good. If you look in New South Wales, perhaps the Hunter or Newcastle regions, or down near Wollongong. So those sort of more major regional areas are doing well, and I think will continue to do well. If you're looking at freestanding dwellings, again, if you can try and find things that are in that sort of infill situation, that may be giving you a better outcome than going far out into the growth corridors, but obviously at a different cost. Boutique buildings, the owner-occupier style space, that's something that we're seeing a large demand for, and certainly in that, as I say, the 3-bedroom or 2+ NPR configurations, I think will continue to grow strongly. So what else do we do? And this is the important area. We look at things quantitatively, so we show our clients and help our clients, and we go through all the costs of acquisition and ongoing costs of ownership of investment properties, and see how that plays out. So we can assist people and say, rather than saying, gee, I hope this works, you should be able to have a look and get a pretty good idea how the numbers should work out over both the short and long term. This is interesting in terms of the more usual scenario, and probably get back to that actually in the next number of years, where if you bought a property, an investment property, you were paying a very small amount, and then the tenant and the tax office were contributing a far larger component to that to assist you with your capital purchase. Currently, and I say currently, it still is currently, that's what people should realise, with interest rates where they are, that picture is far more attractive. And as I said, even if it moves back to this, it's still very attractive. But people should look at this, and if they feel it's right for them, they should probably take some action in relation to that. We've been doing this for quite a long time, as I said at the beginning, over 3 decades. We've helped people expand their asset base and manage their tax affairs in an orderly manner. We have access to higher lending rates for Australian expats, so 85% LVR with no mortgage insurance, which certainly has helped a lot of our clients potentially purchase their first property, but also then grow their investment property portfolios in a far more efficient manner than if you're using your own capital. These are sort of the 4 steps to effective investment we look at, and we do this all the time in terms of initial consultation to see where you're at, what your current position is, to see if we can help you, and if we can, how. Then looking, as we have it there, through the various steps of areas that you may want assistance with, and then we're there for the long term, because most of our clients remain with us for decades. So it's one of those things that becomes a mutually beneficial relationship scenario, and I'm sure many of our clients can attest to that and help others if they need some feedback. So we'll go into a Q&A.
Hi from London. In terms of if you had a capital to invest in buying a property outright versus actually getting a buy-to-let in terms of a mortgage, what would your recommendations be? I think you might have touched on that.
Yeah. So look, are we talking about buying a property in Australia?
Yeah.
Yeah. That's a pretty easy one. You try and borrow as much as possible because of the tax advantages. And that's one reason. And the big reason also is, as I say, money is still very, very cheap. So, if you can get money and say you fix it for 5 years at whatever, 3.5%, right? I mean, you're buying $1 million property, if we can give you 850,000 of that at that sort of interest rate, it's a pretty attractive outcome, because that means, perhaps in 18 months or 2 years, you might say, well, look, I can actually buy another one.
Yeah.
Right? So that's how you start building a sustainable portfolio, not willy-nilly, but in a process-driven manner along the way. And you'll end up with a lot of expat clients that live in different places, and then, when they finally go home, they might have a property portfolio that's worth many millions of dollars, whereas the other way, it's something they think, oh, gee, we should have done that. We've had one of our economists saying that property prices could come down. It's Chris Joy, and he was very accurate in predicting what was going to happen to property at the beginning of the pandemic. And he said after interest rates go up by 100 basis points, property is going to come off by 15 to 25%. And look, I certainly respect Chris's view, but I think that potentially what I said earlier will perhaps not see that come to pass, because as I've said in the past, we've only seen moves of more than 5% contractions occur 4 times since 1981. And more importantly, I think this time, an interest rate rise of 100 basis points may seem like a lot when you're coming from 2%, but in reality and over time, it's not a lot. Interest rates will still be extremely cheap. Monetary policy is still very accommodative at this point in time. A large percentage of mortgage debt is currently on fixed rates that's going to roll off over the next few years. So there are a lot of structural, I think, issues that we need to bear in mind, and I don't actually see that outcome occurring certainly over the next 12 months. And let's be serious, markets have priced in virtually double that increase, so from 0.1 to a bit over 2% in terms of the cash rate. If that were to happen, our property prices are going to decline by 50% between now and the end of 23. My answer is no. So, they're the things to bear in mind. Obviously, one needs to keep an eye on what's happening in relation to central banks potentially making a policy error, and that relates to raising rates too quickly and too far to try and tame rampant inflation. I'd probably wait and look at what's going to happen to some of these supply side issues that we have as pandemic restrictions unwind. So that's my answer to that one. No, I don't think that's going to happen in the short to medium term.
Just given that a lot of the fear mongering around the interest rate rise, do you think that is going to hit a particular type of property, or a particular, like often, a lot of, especially if you're overseas, a lot of the investment you're getting into is off the plan, and various projects. Do you think it would hit either on a project basis, and so by a sort of development potential risk, or is it a particular type of property that might get hit more?
Look, we could get granular in terms of property demographics, if you like. So first home owners is a demographic that could be hit, because those people haven't been used to paying a higher rate of interest, generally speaking. Younger demographic, probably haven't seen inflation. I've seen inflation at 15%. And I certainly don't think we're going there, by the way. But anyway, what I'm saying is that they may struggle a little more. So I think some of the potentially lower end of markets may be impacted more. And then also at the very top end, potentially, there are going to be some impacts there, but I think they'll actually be minimised because right at the top end, generally speaking, people have more equity they can contribute if they choose. It's probably sort of in that lower upper end where people have overextended themselves. You'll find, generally speaking, it's the higher income households that have these loans that are over 6 times, debt to income. So I don't think it's certainly not related to a particular building or at that level at all. So it's more in relation to where that's heading, but don't forget that's what APRA has been there for. And as I'm saying, and you would know this, when you go for a loan, the bank is already assessing you at over 5%, 5.25% interest rate, not 2.25% that you may be paying. So there's quite a bit of stability already contained within the system. The other thing is there is also a lot of buffer room. So the median borrower prior pandemic had about up to 1 year's worth of buffer in their mortgage prepayments, if you like. Currently that's more than 2 years. So it's a pretty healthy buffer. In most countries, 1 year was considered, pretty big. So it's now double that because people have also saved some of the money during this time rather than just spent it on purchasing goods. So that's another important factor that we need to look at. And then the third important factor that I believe is also, very, very pertinent, as the international border is now opening, and the government has already said they're going to kickstart the situation of bringing in a whole lot of migrants that are both skilled and unskilled, and students obviously, that's also going to, they need to live somewhere. Now, they may not buy something initially, so certainly I wouldn't advise them to. They'd want to rent something to see where they want to go. But, all of those are pretty structural, strategic drivers that I think, people just don't think of, but they can't argue with. I mean, they're real, they're there. So, and last but not least, the reason interest rates are rising is because the economy is performing very strongly. And the RBA governor has told us many times, look, we're waiting on wages growth to exceed 3% to look at raising rates. So if you raise rates and your income's going up, and generally then your rental income is also going up because that usually follows inflation, CPI, as you can see, those things work in tandem to enable you to withstand those negative headwinds. Does that make sense?
Yeah, it does. Thank you.
Yeah.
Hey, Doug, it's Lee again.
Yeah.
Just on obviously the upcoming federal election, how do you think that's going to impact property prices next year and going forward?
Look, to be honest, given the agendas of both parties at the moment, I don't think it's going to have a massive impact either way. I mean, the incumbent government has come out and said they're going to, as I say, turbocharge immigration. I'm pretty certain that if Labor wins, they'll go along the same similar path because the Australian economy needs it.
Absolutely.
It's not an election issue, an electioneering issue at this point in time. It's just pure economics, and it makes money for the country. So I don't see the election outcome per se impacting property prices as a result of this election. Esther, can I have your thoughts on the Gold Coast versus Brisbane? Well, I mean, two different markets. So Brisbane, I think, potentially will, at this point in time, offer you a greater choice of value. It's more conservative because it's a state capital. Mind you, Gold Coast now the 5th largest city in Australia. Lots of infrastructure being built in and around there. Has a benefit of that lifestyle scenario, work from home. So I think they're both good, to be honest. And it really depends, perhaps, on your current situation. Do you have current investment properties? If so, where are they, and so forth. Could depend on a lot of other factors in terms of you choosing where you might want to invest. please feel free to get in touch with us, and then we can look to book a time separately to assist you. I hope you've all enjoyed it and found it useful, and I'll see many of you on our Q&As. Otherwise, on our next quarterly update, and we'll see how those charts are going, Mark, on an ongoing quarterly basis to make sure we're on the right track. All the very best to everyone, and look forward to seeing you next time.